Thank you all for joining our 15th annual Investment Management University. Our first program today is Hot Topics in the Investment Advisor Regulation area. My name is Stephanie Monaco, and for those who have been to and participated in any of the previous 15 Investment Management Universities, we're old friends at this point. I will be your host for this series, and first I will cover a few administrative matters and then we will get started. If you are applying for CLE credit, you will need to record the alphanumeric code provided during and at the end of this program on the affirmation forms. We plan to allow time during the program for questions. Again, our format is just come out with your questions whenever you have them, and we will try in this remote environment to steer them to the right person and get answers contemporaneously. So without further ado on that, I am pleased to introduce three of our new partners since last IMU. The first partner I have the pleasure of introducing is Erin Cho. Erin advises companies on a wide range of matters involving Erisa's fiduciary and conflicts of interest rules. She has extensive experience advising broker-dealers, asset managers, and insurance companies regarding the many and varied services and financial products, including structured products and derivatives, those that are provided to U.S. pension plans. Erin counsels hedge funds and private equity clients on the consequences of accepting investments by benefit plan investors, as well as plan assets and prohibited transactions. It is such a pleasure to have Erin here. And again, for those who are long-term Mayer Brown clients and friends, Erin is working in conjunction with our dear partner and colleague, Lenino Kino. They work very closely together, and Erin is going to start us off. Before I hand it over to you, Erin, I'd like to introduce our second speaker today, another new partner of ours, Christina Thomas, and she most recently joined us from the SEC, where she served as counsel to Commissioner Roisman. In that role, she provided legal counsel to him on his consideration of policy, regulatory enforcement matters. She advised on the improvements to the shareholder proposal process and proxy solicitations. She also advised on the modernization of Reg SK disclosure, updates to statistical disclosures for bank and savings and loan registrants, and the harmonization of exempt offering framework and other major rulemakings. She also served as lead advisor on international securities law and policy matters. And before that, she worked in the Division of Corporation Finance and also in the Office of Mergers and Acquisitions. So she was the one whispering in the commissioner's ears. And we're delighted that she's joined our firm. Our third speaker on this panel is Tim Clark. He joined us along with other partners in our fund practice, Marina Bassignano and Javier Fierro. Our firm has made it a priority based on our client expectations and needs to really build out our private fund capabilities. In prior years, of course, you have met Tram Nguyen and Aubrey Smith and Christine Corin, Ileana. We have a wonderful fund formation team. Tim has added to that, and he focuses on fund formation, investment advisor acquisitions, and co-investments. And he works with secondary transactions and advises a broad range of investors and funds, including infrastructure, private equity, direct lending, and sovereign wealth funds. He has a deep knowledge in financial regulations and is a great addition to our investment management practice. So with that, I will turn it over to Erin. You'll all be thankful to know that where it comes to core investment management updates, what has been happening with the examination program, I will cover at the end of this so that most of the panel will be enjoyable. Erin, it's up to you.
Thanks so much, Stephanie. I'm really excited to be here today and really look forward to meeting and working with you when we're finally back in person. So I'm just going to start off with, why do we care about Erisa? I know the acronym makes many folks' eyes glaze over. After all, it's been called every ridiculous idea since Adam. Well, we care because there's over $30 trillion of US retirement assets in this country, with $10 trillion in 401k plans, another $10 trillion in IRAs, and rollovers, or the flow of money from 401k plans to IRAs, constitutes at least $2 trillion each year. And the numbers just grow on a day-by-day basis. So the Labor Department has
Erin, can we advance the slides?
Yeah.
Cyrus, could you advance? One more, please.
Yeah, great.
There we go.
Right. So the Labor Department has recognized that advice to plan participants to roll over assets has become big business to firms. And under the belief that it's too easy for brokers and financial advisors to avoid ERISA fiduciary status under a 5-part test established in 1975, the Labor Department has been trying to elevate the standard of care since the early days of the Obama administration in 2010. And so what the Labor Department has been repeatedly trying to do is broaden the scope of who would be considered an investment advice fiduciary. Once you become a fiduciary under ERISA, selling investment products or recommending rollovers that can increase your compensation becomes a prohibited conflict or prohibited transaction unless you comply with the Department of Labor exemption. So in 2016, the Labor Department issued a brand new definition of who would constitute or become an investment advice fiduciary, as well as a best interest contract exemption, which included onerous disclosure and contract requirements, as well as limitations. So several challenges to the 2016 fiduciary rule were pursued through the courts by the industry, and ultimately in 2018, the U.S. Court of Appeals for the Fifth Circuit issued an opinion vacating the 2016 fiduciary definition in its entirety, as well as the best interest contract exemption. But in the meantime, some financial institutions had developed investment advice programs based upon the best interest contract exemption, and realized that the best interest contract exemption actually provided certain advantages, namely the ability to sell proprietary products and retain all of the compensation. So in response to the Fifth Circuit's ruling, the Labor Department issued 2018-02, which is essentially a field assistant bulletin or a non-enforcement policy. And it provided transition relief to investment advice fiduciaries that made a good faith effort to comply with certain conditions of the best interest contract exemption. This FAB also stated that there would be a non-enforcement policy by the Labor Department for these firms who made an effort to comply until permanent exemptive relief or regulations were issued. And this non-enforcement policy is now set to expire on December 20th of this year, because the Labor Department has now issued Prohibited Transaction Exemption 2020-02, which I'm going to refer to as the Investment Advice Exemption. After December 20th of this year, we expect the Labor Department to start aggressively investigating sales and rollover practices. So I'm just going to give you a brief summary of the exemption, where we stand today, and the difficulties. So the first slide here, the exemption provides broad relief for the receipt of compensation by financial advisors, brokers, in connection with non-discretionary advice. And it includes the sale of proprietary products. So the great news for financial service providers is that we now have an exemption where they can sell a broad range of investment products and retain all of the compensation. Until now, existing Labor Department exemptions that provided for some relief for the sale of proprietary products. For example, some of you may be familiar with 77-4, which allows advisors to sell proprietary mutual funds, requires waivers or rebates of product level fees. But this exemption allows advisors to retain all that compensation. So, but of course, there is a catch with respect to some of the conditions, which we're going to get through in a moment. There is also exemptive relief for limited principal transactions. Historically, the Labor Department has never permitted a fiduciary to utilize its affiliated broker-dealer to execute principal transactions because of the embedded conflicts. But for certain principal transactions and riskless principal transactions, this exemption does provide relief. And I see some utility with this principal trading exemption, but most of our clients are saying it requires a significant tech build out. So if we can move to the next slide, please.
And Erin, if I could just interject just right now for a moment. So many people, it seems pretty obvious, but so many people will ask, well, individual retirement accounts, they're not Erisa accounts. So why do I have to worry about proprietary transactions? Why do I have to worry about principal transactions? Why do I have to worry about any of this? We're not Erisa. We don't have Erisa clients. We have IRA clients after all.
Right.
What do you usually say?
Right. So there's a Reconciliation Act going back decades ago that allows the Labor Department to extend its regulatory authority over IRAs. But most importantly, IRAs are subject to prohibited transaction rules in the Internal Revenue Code. Before ERISA was passed in the 70s, it was actually the tax code that provided protection for retirement assets. So while IRAs are technically not subject to ERISA's fiduciary rules, for all intents and purposes, they are subject to almost exactly the same prohibited transaction or conflict of interest rules. So that's why IRAs are included under this exemption.
Right.
So the advice exemption, again, excludes in-house plans of financial institutions. So what that means is that a Goldman Sachs broker cannot provide rollover advice or investment advice to participants in the Goldman Sachs 401k plan. It doesn't apply to robo-advice programs. And importantly, it does not apply to discretionary management of relationships. So in ERISA world, we call those 338 relationships, fully discretionary relationships. Again, this exemption only applies to advice or non-discretionary relationships. Next slide, please. And these are some of the conditions of the exemption. The tricky thing is that it's principles based. And so it doesn't prescribe in every fine detail what you can or cannot do. And the difficulty with some of the conditions is that it's easier said than done in practice. So for rollover recommendations, for example, advisors and brokers need to obtain copies of the participants' disclosure documents. I mean, that's not something that retirement clients easily, have handy. They need to compare investment options under their existing 401k plan with the investment options that, for example, an IRA that they are offering may invest. They need to compare costs. They need to compare services. They need to also consider other alternatives to a rollover, including keeping the retirement money in the 401k plan or considering other investment options under that 401k plan that the participant may not be invested in or may not have considered. And all of this needs to be documented. So this requires a pretty significant tech system build out. Supervision and monitoring is also required under the exemption, which again, having alerts built in to, again, requires a technical build out. We're talking about, in many cases, thousands of brokers and financial professionals, and even that multiplied by that number, many times more retirement clients. The exemption also requires minimizing compensation incentives to favor one type of account or another, favoring one type of investment product or over another. It requires levelizing compensation that brokers or financial professionals receive within investment product categories. So if I am, a broker shouldn't be compensated more for recommending a Vanguard mutual fund or Fidelity mutual fund. So these require complete, again, review of compensation practices. Compensation grids need to be reviewed. Again, the Labor Department does not like big jumps in compensations or hurdles from incremental sales recommendations. There is an annual retrospective review as well, which requires a written report to go to the CEO of the advisor or the institution or one of its, named executive officers. So, but with the, with the Labor Department's, non-enforcement policy ending on December 20th, financial institutions and investment advisors have to complete all of the build outs by December 20th and are facing training thousands of brokers and financial professionals between Thanksgiving and the December holidays. But we're finding, reputable institutions and advisors are working really hard with us to try to meet this deadline. So,
and Erin, can I just again butt in?
Sure.
So the attraction of this exemption needs to be weighed against the cost associated with it. If you were an organization that did not want to rely on the exemption, where would you stand if you were not going to do this? And I would just say one disincentive that I see, first of all, the exemption is limited to non-discretionary. And so many of our investment management clients, our clients, are providing discretionary services. So, part of it might factor into a cost benefit analysis of continuing to provide non-discretionary services if in fact you wanted to avail yourself of this exemption. But I'm seeing more detriment than benefit associated with relying on the exemption. Am I reading the tea leaves right?
It's a ton of work and a lot of build out, but large financial institutions really, a number of our clients, the other alternative is to rely on investment education. And as we know, say the Labor Department is of this view that it's too easy to try to avoid fiduciary status just based upon education. And some of our clients really felt that to tell a regulator after December 20th that our sales of rollovers or sales of investment products has not changed and it's all education, they felt that that could also invite risk. So, but it's really, as you mentioned, a cost benefit. Others, I think, out there are probably going to, don't want to or don't have the resources to go through this type of a build out. Their option is education. For discretionary programs, you really are going to rely upon what we call hire me or sales. When you're talking about, I have a great private fund, I have, so I think what my asset manager clients who are in the discretionary world are doing are taking another look at their training policies. And they're looking at training or revising training policies to ensure that their folks know the difference between sales and crossing the line into investment advice. So that's going to be very, very critical, again, to reinforce that line. Other clients who have programs where they provide investment advice or discretionary programs and sell proprietary mutual funds, proprietary products, have actually decided there is great benefit with this exemption because we can retain all the comp, and they're switching to just pure advice programs. So folks are a bit over the map, but for many of the largest institutions, that financial institutions we work with, they felt that it would invite more regulator scrutiny to just tell the Labor Department, go away, we only rely on education.
And just to be clear, I think I heard you say that the challenge is to make sure you don't cross over the line with an N between sales and advice, not the lie, right?
That's correct. That's correct. There's currently right now the 1975 5-part test is the law. If you go to the next slide, and can turn to the next slide, please. The Labor Department, and just to review that 5-part test, it's basically investment advice pursuant to a mutual understanding that is the primary basis that the client relies on as the primary basis for that advice. It has to be on a regular basis. So there are these prongs that need to be met before you cross that line from sales or education into investment advice. Sorry, if you go to the prior slide, I think one right. What the Labor Department again has articulated under the Biden administration is that they still feel that it's too easy for people to evade fiduciary status and they have not ruled out issuing a new regulation redefining investment advice. So we're going to go back again, probably, to 2016. They have not ruled out making further tweaks and amendments to the investment advice exemption. And they are planning to amend or revoke other commonly used exemptions in this space. So what their desire is to put people and force people into utilizing this 2020-02 or investment advice exemption. And a number of our clients, as recently as yesterday, have received, this is financial institution, insurance company, brokers, have received letters from the Labor Department inviting them to come forward to comment on any of these topics. So it's something that they're, very, remains to be a very active area, and will keep folks, I think, in this space pretty busy. So I want to turn over to the next hot topic. If you could change the slide, please. And it's just cybersecurity. In the spring, the Labor Department issued tripartite guidance in this area. And the backdrop, just to take a minute, is that retirement plans, particularly again 401k plans, have been targets for cyber theft. You can find a lot of information about participants really through the dark web. It's well known that plan participants don't check retirement statements as often as credit card statements. So a lot of this has created a perfect environment for cyber attacks. And we have seen clients have 401k plan participants that have lost all of their savings. And so if they're, if the plan sponsor or the service provider responsible for these losses does not make plan participants whole, lawsuits have resulted. So it was against this backdrop and also pressure from GAO, the Labor Department issued this new guidance. And we are seeing plan fiduciaries, or you should be seeing soon, that when they hire or contract with an asset manager, they will need to be asking or be required to be asking certain diligence questions. And those some of those questions from the tips are here. Does a manager hire a third-party auditor to annually review? Does the manager utilize best practices and comply with industry standards in the cyberspace? What type of cyber liability insurance does the manager maintain? So these are required. You could turn to the next slide. And so you may be asked when you're negotiating with plans on the other side to include certain notice provisions. Plan fiduciaries may be emboldened to negotiate indemnity provisions. So this is just something to keep in mind if you're an asset manager or other service provider in the retirement space. the Labor Department has said that they are keen on finding out to what extent plan fiduciaries are complying with this guidance, and it's become one of their latest investigation priorities. We are seeing just in routine audits and investigations of plan service providers, as well as plan fiduciary committees, questions that are really, rooted in these tips. So I think that, again, this Labor Department initiative is in its infancy, but we really do expect to see many more investigations and questions in this area to come. And so obviously the best time to prepare for this is before you are investigated.
I would say the best time to prepare for this was last year. I will mention that yesterday there was an announcement of the SEC bringing 8 different actions involving failures of cyber policies and procedures. We probably will talk about these cases on the enforcement panel, but if anyone is interested, there were attacks, cyber attacks on investment management firms that involved getting personal information on individuals that the advisors had. And these are rather stark cases. And I think, like you said, Erin, many more to come. Cyber is definitely a top priority for the exam staff, and something that should be, along with so many other competing priorities at investment management firms.
Yeah, that's great. Yeah. So could turn to the next slide, please. So I'm going to wrap up with ESG. This has been a very hot topic, not just in the Erisa space, but in the investment management space generally. But again, just to give you a brief overview, the Labor Department has issued, there's been 40 years of sub-regulatory guidance in the Erisa space. And while the details and the tone changes, from administration to administration, with Republican administrations being more skeptical of ESG and Democratic administrations being more pro ESG, the broad principles when it comes to ERISA plans really remains the same, namely that risk and return are paramount. So the Trump administration decided that it wanted to clarify the rules once and for all and not have this back and forth, between administrations. And, it definitely came from a bent of being skeptical of ESG investing, and they were under some pressure from the oil and gas industry. So what the Trump administration did in its waning days was they amended ERISA's investment duties regulation and issued what we call the financial factors or ESG rule. So next slide. So basically the rule codified just longstanding principles articulated by Republican administrations, which emphasized economic or pecuniary factors with respect to plan investment decisions. There's been a long-standing tiebreaker test. So if 2 investment options are under, pecuniary as a pecuniary matter similar, you could consider non-pecuniary factors or even ESG factors, is the way the rule put it, as a tiebreaker. And so while the rule retained this test, it did express tremendous skepticism about this test. And the rule included pretty burdensome process and documentation requirements if a plan fiduciary committee, for example, or an asset manager that advising a plan is to consider, ESG type factors, which they equivalent in their minds are non-pecuniary to utilize this tiebreaker test. The rule also prohibited ESG funds from being used as QDIAs. And what a QDIA is, it stands for Qualified Default Investment Alternative. is when a plan participant in a 401k plan doesn't designate where he or she wants his or her contributions to go. Those funds are automatically invested in what we call this QDIA fund. And the rule prohibited ESG funds from being designated as QDIAs. And there's obviously a lot of money in QDIAs. So this was a great negative to fund, manufacturers and providers of ESG products. So at the same time it issued this rule, the Trump administration launched dozens and dozens of investigations on asset managers, plan fiduciaries, consultants, anyone that, one even spoke to the press about being positive about ESG products, or they would look at fund PPM documents. And if there was a disclosure statement about ESG factors being used, the fund sponsor or the asset manager immediately got, one of these notices or letters from the Labor Department. So the combination of the rule and these enforcement actions just has frozen ESG investing for Erisa plans. So if you can turn to the next page. The Biden administration, of course, once it came in, it quickly issued a non-enforcement policy. These investigations, gradually, quickly kind of went away or wrapped up. They issued an executive order to the Labor Department directing the secretary to either rescind the Trump administration's rule or to issue a proposed new rule. And the deadline is September 2021. So this proposed rule issued by the Biden administration is going to be issued any day now. It is currently at OMB. So we are waiting, and I think it's just of great interest to folks on both sides of the aisle, because honestly, neither the asset managers or the plan fiduciary committees were enthusiastic or happy with the Trump administration rule. The general preference is to remove governmental interference with these types of products and leave it to the professionals and fiduciaries to make those decisions. So I think with that, I can turn things over to Christina, who can pick up. I think is going to pick up with the SEC side of things on ESG.
Thank you, Erin. Go ahead, Christina.
Thank you, Erin. Thank you, Stephanie. If we could please move the slide. I think, yep, perfect. Thank you. So good afternoon, everyone. Thank you. Thank you for joining us today. So as Erin mentioned, I'm going to cover SEC priorities and initiatives. And I think it was a good segue that she ended with ESG, because I don't think we can talk about SEC priorities without covering ESG. So the recent change in administration brought with it a new SEC chair and new priorities with respect to the regulation of investment management. And while we're still in the early days of Chair Gensler's tenure at the SEC, I think we already have a fair amount of insight into his areas of focus and what we can anticipate in the near future. So today, specifically, I'll discuss SEC priorities and initiatives, which include the regulatory agenda and the work of the SEC's Asset Management Advisory Committee, and I'll briefly talk about some recent enforcement issues. So because of all of these topics overlap with the SEC's focus on ESG issues, I'll start there, and I'll try to go in chronological order, because there has been a lot happening in this space since January of this year. To start with, an investor bulletin was put out warning investors to ask questions before investing in ESG mutual funds and ETFs. And then in early March, the SEC's Division of Examinations, which is formerly known as OC, published its 2021 examination priorities, which included an enhanced focus on climate and ESG issues. Commissioner Lee, who was serving as acting chair at the time, stated that this year the division is enhancing its focus on climate and ESG-related risks by examining proxy voting policies and practices to ensure that voting aligns with investors' best interests and expectations, as well as firms' business continuity plans in light of intensifying physical risks associated with climate change. Soon thereafter, the Division of Examinations issued a risk alert that detailed observations of deficiencies and internal control weaknesses from exams of investment advisors and funds regarding ESG investing. The staff noted that it's going to continue to examine firms to evaluate whether they are accurately disclosing their ESG investing approaches and have adopted and implemented policies, procedures, and practices that are consistent with their ESG disclosures. So taking a step back with respect to proxy voting, you may recall that the SEC in the last administration adopted guidance for investment advisors regarding proxy voting responsibilities and the use of third-party proxy advisory firms. Specifically, the guidance was meant to assist investment advisors in complying with the proxy voting rule, which was adopted by the Commission in 2003. And that rule states that it is a fraudulent, deceptive, or manipulative act, practice, or course of business within the meaning of Section 2064 of the Advisors Act for an investment advisor to exercise voting authority with respect to client securities unless the advisor follows specific requirements in that rule. The guidance in 2019 was drafted to be consistent with the more recently adopted fiduciary interpretation and covers how an investment advisor and client in establishing their relationship can scope the advisor's authority to vote proxies on the client's behalf. The guidance also touches on whether and when the advisor must vote. The SEC also provided guidance on the responsibilities of investment advisors when using the services of a proxy advisory firm to assist with voting. So even though Chair Gensler seems pretty keen on revisiting the SEC's rules and interpretations as they relate to proxy advisory firms, he has not indicated that 2019 guidance for investment advisors is subject to change. So given the increased focus on proxy voting, especially in the ESG space, it would probably be a good time to read the proxy voting guidance as a refresher on advisors' responsibilities when voting. The day after the publication of the 2021 exam priorities, the SEC announced the formation of an enforcement task force focused on climate and ESG issues. Now, in addition to identifying material misstatements and omissions in issuers' filings, the task force has taken up the task to analyze disclosure and compliance issues relating to investment advisors and funds ESG strategies. Now, there are no new rules to be aware of at this point, but the creation of this task force should be viewed as a reminder to registrants that existing statutes and regulations are applicable when it comes to ESG. And while no new actions have been brought by this task force, it has been reported that an asset manager affiliated with a large investment bank is being investigated by both the DOJ and the SEC for overstating its sustainable investing efforts. So I think sort of the takeaway here would be that if you are marketing an ESG investment strategy, be very careful about what you disclose to investors, because there is still a lot of ambiguity and inconsistency with respect to what people consider to be ESG investing. So you may wish to evaluate the effectiveness of your disclosure controls and procedures as they relate to climate and other ESG disclosure. To the extent, oh, yep.
Go ahead, Christina. I just wanted to throw in, if you don't mind. I think a lot of advisors struggle with, there is no real definition of ESG. Right. And so as they approach their Form ADVs, as they approach descriptions of strategies in their PPMs, I'm seeing sort of a confusion maybe that, you know, it's almost like they feel compelled to discuss ESG, that it's expected that they discuss ESG, but there seems to be confusion over, well, do I discuss at least the S and the G part of it, where the investment management governance of a firm is concerned? Or should I really be talking about an ESG approach to investing clients' money in an ESG direction? And should every advisor, is it our advice, is it your advice, that in those documents, you know, very important documents, a federal filing with the SEC in terms of the ADV, you know, 10b5 risk documents associated with a PPM, and the offering of interest in private funds, that they define what ESG means in their minds and how either it is being advanced at the firm or how it is being a factor in making investments of client money. Is there any clarity on that or expectations?
So, yeah, so at this point, and that's kind of the issue, right? There is no consistency here. And so you're bound by the same rules in terms of what you're disclosing and making sure that that it's consistent with what you're actually doing. But it's not as easy as other investment strategies that are, well established and kind of common understanding. Here, yeah, I think the more detail and more transparency that you can provide, the better, because it's been made abundantly clear that the SEC is looking at this and they're going to be comparing what you're disclosing to what you're actually doing. And everything always comes back to, whether you're acting in the best interest of your clients, of your investors. So I do think, for the time being, it is an area to pay close attention to. I think we are going to see more regulation in this space, and I think that's actually a good prompt for me to turn to sort of what's going on in the rulemaking space. So, as I mentioned, no new rules have been proposed or adopted yet, but taking a look at the SEC's recently published regulatory agenda, we can expect to see a fair amount of action in the near future. So I know, Stephanie, you're going to discuss certain items on the agenda in more detail later, but I'll flag a few right now. So in the ESG space, I'll start by mentioning an area that the Commission has been talking a lot about and wants to move on quickly, and that is disclosure rules for public companies related to climate change, board diversity, and human capital management. The Commission wants to know what information investors are using or need to make investment and voting decisions. So to the extent that a firm does employ a strategy for climate or ESG investing, you would want to consider whether a proposal on climate and ESG for issuer disclosure would be something you'd want to weigh in on, because even though the rules will only directly apply to public companies, there are going to be implications for asset managers. And I say that because Chair Gensler has expressed concern about the data and criteria asset managers are using to ensure they're meeting investors' targets when funds are marketed as sustainable or green or ESG funds. And he's asked the staff to consider recommendations about whether fund managers should disclose the criteria and underlying data they use, since there are no standardized definitions in the ESG space. So, if that's something you've directed the staff to do, I think it's a safe assumption that likely something is going to come of that. So if he's looking for more detail, I think that's a good signal that you want to review your disclosure and think about whether it needs to be bolstered. He has also noted asset managers' increased use of third-party service providers and has stated that claims made by, for example, ESG ratings companies raise a number of questions about the data underpinning those assertions, whether certain service providers are providing investment advice, and what advisors' responsibilities are with respect to their use of those services. And I think, based on the regulatory agenda, we can expect the Commission is likely going to seek public comment on the role of certain third-party service providers, such as index providers and model providers, and try to figure out a little more about what their implications are for the asset management industry and whether more regulation is needed.
Christina,
yeah.
I'm sure you read that Chair Gensler has hired as his counsel Barbara Roper.
Mm-hmm.
I don't know. I could be cynical. I'm not really sure, but to the extent that we're seeing, and we do see it in the exams, a heightened regulatory bite by the SEC, that to the extent Chairman Gensler is advised by Barbara Roper, is it likely that we're going to see even more regulation? How does she do you have a sense of what her views are on the importance of ESG and diversity and all of these particular subject matters?
Right. So no, that's a good point, Stephanie. So yes, Chair Gensler recently hired Barbara Roper, who was formerly of the Consumer Federation of America. And we do know a bit about her views because she did serve on the Investment Advisory Committee for several years at the SEC. So, I think that, there's going to be a trend towards more regulation, more enforcement. I think that's from what we've seen so far and from what we've kind of been promised from the SEC, we're going to see a lot more in that space. I think that's right.
Trying to tell the hairs on my arms to settle down.
Yeah, I think you're not the only one. So just a couple more matters relating to SEC rulemaking that I wanted to point out. You may recall that just last year, the Commission put out a request for comment on the names rule, which governs funds naming conventions. And while the focus of that release was not on ESG funds exclusively, it did note that according to SEC data, the number of funds whose names included terms like ESG or sustainable or green increased by over 300% between 2007 and 2019. And Chair Gensler recently stated that he has asked the staff to take a holistic look at naming conventions. So I wouldn't be surprised if ESG naming gets pulled into that and is sort of highlighted as an area where more regulation is needed. And then something that's not ESG related, just last week I wanted to mention the SEC put out a request for information and public comment on matters related to broker-dealer and investment advisor use of what they're terming digital engagement practices on digital platforms. Also a request for information on investment advisor use of technology to develop and provide investment advice, so robo-advising. Now, I think the focus here, especially in the reporting on the release, has been on gamification related to stock trading. But the focus here really is on the broker-dealer investment advisor interactions with retail investors. And at its core, this request for information is appearing to seek more information about potential conflicts of interest and other investor protection issues. So, even though it's being sort of marketed as something that strictly relates to gamification, I would suggest reading the request to consider whether it's worth responding to any of the questions that may signal implications for the investment management industry. I'll note just yesterday, Chair Gensler gave a speech stating that he's concerned about whether the broad adoption of deep learning models could contribute to a future financial crisis. So again, another area where it wouldn't be surprising to see some more regulation. So if that's something where you feel you have insight and ability to weigh in and educate the Commission, that's a good opportunity. So Stephanie's going to cover the rest.
Converse to that one, can I just ask you, Christina, a lot of our advisor clients have to report on 13F, and one of the last sort of rulemaking proposals of the prior administration was to raise the reporting thresholds. We do have some clients, and we were ghostwriters on comment letters. Is that a dead letter?
Yeah, so that proposal turned out to be pretty unpopular. I think that there was, a bit more of a reaction, I think, in terms of, I think the focus was trying to sort of alleviate some burden for asset managers in, especially for smaller ones and what they have to report. But, there was a lot of response from other market participants explaining that, this information is used by a lot more people than I think the Commission appreciated. So I don't really foresee the Commission this go around taking up rule proposals that were meant to diminish a regulatory burden on anyone. I think that, there's a lot of focus on transparency and disclosure. And I'll note that, on the regulatory agenda, I had to read it twice because I thought maybe I had an old one, because so many of the rules listed are ones that the last administration already tackled. And so they're opening up a lot of recently adopted rules and planning to change those. So yeah, I don't foresee the 13F rulemaking getting opened back up, but that's my take on it.
And not to make an offensive statement to your Commissioner Roisman and Peirce, but of course they've come out and criticized the Gensler Commission for reverse engineering all the rules that were adopted in the prior administration, as if they're crying foul for the first time and they would never do it themselves. I'm just saying, I mean, I don't like to get into politics, but everybody in the industry has to pay the price of the change in administration and the change in ideas, and they are as polarized as our country. It's either black or it's white. So they throw all this money to deal with a fiduciary rule, Erin, and they try and re-engineer how their 13F reports are going to be designed in anticipation of an adopted release. And now everybody's got to deal with a daggone marketing rule that is a total overhaul, only to hold their breath and wonder what is the fate under new administrations. It's pretty lousy to be in the industry.
No, I agree. There's a lot of whiplash here in terms of, planning for something and not knowing if it's actually going to become a requirement, or if it is, how long is it a requirement for?
Exactly.
Sorry. Oh, no, sorry. Anything else you wanted to cover?
Oh, there's so many things I wanted to cover, but you finish with your presentation and we'll move on to Tim when you're ready.
Okay, sounds great. So just, I'll quickly cover the updates on what the SEC's Asset Management Advisory Committee, or AMAC, has been focused on. So this is a committee comprised of outside experts who represent the views of retail and institutional investors, small and large funds, intermediaries, and other market participants, and they advise the SEC on investment management issues related to pending rulemakings and other industry-related topics. So earlier this year, they published recommendations on both ESG disclosure and diversity. So I think, it's helpful to get a little bit of insight on what the SEC is being advised by sort of the experts that they've selected to provide them with advice. So with regards to ESG disclosure, the AMAC recommended that the SEC take a comply or explain approach to requiring meaningful, consistent, and comparable disclosure from issuers. And specifically, they recommended that the SEC encourage issuers to adopt a framework for disclosing material ESG matters and to provide an explanation if no disclosure framework is adopted. But with respect to ESG investment product disclosure, the AMAC recommended that the SEC suggest best practices to enhance ESG investment product disclosure, including alignment with the terminology developed by the Investment Company Institute ESG Working Group, and clear description of each product strategy and investment priorities, as well as description of non-financial objectives such as environmental impact or adherence to religious requirements, and also suggested that the SEC should provide suggestions of best practices for investment products to describe each product's planned approach to shared ownership activities, and any recent notable ownership activities outside of proxy voting in Form NPX and shareholder reporting. So, these are recommendations that I think fall short of asking the Commission to come up with bright line rules, and rather, seeking guidance instead on best practices. So we'll see. The SEC does seem to want to provide more bright line prescriptive disclosure requirements. So we'll see if that has any impact. And then in the diversity space, their recommendations focus on disclosure to provide transparency of diversity within firms, and disclosure of fund board and fund advisor diversity. And they'd like to see guidance to fiduciaries in selecting asset managers. The view is that, based on their studies, that diligence checklists tend to exclude more diverse firms, and so they want to sort of rethink the best way to approach that, and then they have a recommendation in the pay-to-play universe. So they'd like the SEC staff to study the influence of political contributions on asset allocation in the institutional market. So that's been the two areas of focus most recently for the AMAC. And then just briefly, I'll mention recent SEC enforcement actions. Stephanie and Erin covered the recent cybersecurity enforcement actions that were brought against several firms for failure to adopt and implement cybersecurity policies and procedures. And as I mentioned, we can likely expect to see matters brought by the SEC's new climate and ESG task force. So those are two areas to look out for in the enforcement space. But as Stephanie mentioned, the enforcement matters are going to be covered in more detail at a future panel. So with that, I will turn it over to Tim, unless Stephanie, you have a couple of remarks.
So, Tim, private funds. Hit us with your best shot.
The soft underbelly has come to me. I will say, on I've had a number of, this sort of relates to the ESG discussion we're having. I've had a number of clients who, had sort of what I'll call sort of green ESG stuff in their PPMs, and have had that there in particular in the open-ended infrastructure space for 12 years at this point, and we've encouraged them to have another look over the last couple of years at that disclosure, most of all because that disclosure has tended to be quite unsurprisingly fluffy, and they now have a track record, and you can actually see whether or not they're actually living up to those goals that they set. So given this world and the focus on ESG, it's something that folks should consider, looking at those PPMs, which are actively marketing off of, to make sure they're actually complying with what they say they're going to actually do. So I'm going to talk a little bit about expense allocations, one of my favorite topics, expense allocations and deal allocations. I hesitate just a little bit to start at the beginning. And I'll talk a little bit about how some of this stuff is new. It's not just old. I think, and Stephanie can jump in here whenever I get something wrong, but it's fair to say that these issues have been the focus of the SEC for decades now. In fact, when it's hard to come, besides insider trading, allocation issues are oftentimes the next highest priority for the SEC when they come in and do an exam of managers. Historically, obviously, they had looked at much more intently at hedge fund managers years ago, in particular with deal allocations. That over the years, as obviously after Dodd-Frank, all the private equity funds essentially had to get registered. That's become more of an issue for private equity fund managers. But also, over the last few years in particular, we've noticed that with clients, just frankly because there's been such an explosion of different vehicles that sponsors are running. Oftentimes running next to flagship funds, separate, multiple separately managed accounts, funds of one, all sorts of different kinds of vehicles, which really ramp up the complexity of how deal allocations are being done and expense allocations are being done. So it's a long way of saying what's old is new again, but you want to sort of get this right because the problem if you don't get it right, the penalties are quite high. And as we'll touch on momentarily, I'll need to talk a little faster so we don't run out of time. Disclosure does generally cleanse most of this stuff, but of course, when the SEC comes in, you'll have the usual argument about whether or not your disclosure was adequate. So deal allocation, sort of the basics here on this page. The SEC has had generally a bugaboo when you're looking at deal allocations about how you're actually allocating it between different vehicles and whether or not you're allocating deals, quote, the good deals to vehicles which happen to pay higher management fees and higher carry to the sponsor. Obviously, when the SEC comes in, they have the benefit of 20/20 hindsight when they're actually looking and doing those kinds of examinations of how the allocations were done. But it again sort of argues that you want to have your allocation policies be very clear, good paper trails, all the normal kind of stuff. Allocations between affiliated vehicles. The most obvious kind of allocations here, it's again whether or not the sponsor is allocating deals to affiliated vehicles that are for the professionals and the friends and family. However, again, the last few years, there have been a lot more sponsors that have sold minority interests in themselves. We're seeing, and I've set up a lot of special vehicles for those minority investors that have invested into those sponsors. And there again, you want to make sure that there's not any sort of special deals being done or allocations being done to those minority investors that don't follow the allocation policies and aren't properly described in the disclosure. In general, we like, just skipping to expenses. In general, we like to see disclosure that you're going to be fair and equitable on expenses. We're talking about everything related to deal expenses, due diligence expenses, legal expenses, broken deal expenses. Pro rata is obviously pro rata on capital that's actually going into the deal is kind of the gold standard. Once you kind of deviate from that, there has to be a good sort of reason why you're doing it. And also allocations away from the sponsor for expenses which traditionally hit the sponsor. Those are classically overhead expenses, internal legal expenses, accounting expenses, things like that. If you're going to go down that road of doing those kind of allocations to a client, you want to make sure that the disclosure is very clear. As probably almost everyone on this call knows, the most recent poster child has been KKR. They got dinged a few years ago for about $30 million. Had a $30 million settlement. The SEC came in, found that they were allocating broken deal expenses essentially solely to the flagship funds and not to the professional vehicles funds. There was essentially no disclosure on that. The other problem, which people kind of skip over, is that there also wasn't the proper disclosure and mechanics in the actual compliance materials. So they didn't say they were doing it in the PPM. They didn't say they were doing it in the compliance materials. And then there was no mechanism for the actual compliance folks to sort of monitor and see how the allocations were being done. Again, another sort of classic SEC kind of gotcha kind of thing.
Hey, Tim, can I ask you, I just want to interject a question. And there's so much that I would love to say, but first question to you is, particularly in the private equity world, it's also true in the fixed income world, that allocating investment opportunities cannot easily be done pro rata or pro rata relative to a desired appetite. So, it's not easy to go out and put in an order for 100 of something. And if you only get 10, you give 1/10 to 10 clients. What do you typically see in terms of a fair and equitable allocation procedure of investment opportunities that works outside of the liquid public
Yep.
high capital markets?
Yep. So, I mean, usually I like to see kind of a laundry list of stuff, right, that you may consider, which include, all the normal kind of suspects. It's diversity, capital available, term of the fund, and then perhaps you have other, if you're running multiple products, you may have geography, everything that you kind of would think of in that kind of list, and then you can sort of pick and choose at least, I think, about how you're doing the allocation.
And then where you talk about allocation of deals to affiliated vehicles. So the Gardner-Russo no action letter more or less says that if the proprietary money in a private fund equals or exceeds 25% of the capital of that fund, then you have to consider it a proprietary fund. That's important for principal transactions and cross trades. But under the allocation of deals to affiliated vehicles, do you generally counsel that an affiliated vehicle for this purpose just means that the PMs and the principals of the advisor have their own personal money in that? Is there a threshold where you should care? Do you find yourself counseling on allocating of deals when you've got that kind of proprietary investment that may or may not exceed the Gardner-Russo percentage?
Yeah, that's a great question. Usually it's pretty clear that it's you're way above 25%. So there's not that kind of principal trade kind of issue that comes into play. But absolutely, I think that in the back of all of our heads, you get to 20 or 25%, and the kind of you get a little more uncomfortable, and you want to make sure that you're creating a good paper trail exactly how the allocation is being done.
And of course, on examinations, which hopefully I'll eventually get to talk about, if not on this panel, the other ones. But I'm seeing a lot of examination focus on deal allocations, the clarity of the allocation process, which is really maddening, because if you have a policy of a fair and equitable allocation, they will criticize you if systematically you, for example, use a random allocation, which is not uncommon in the private equity space, because those deals aren't divisible into a number of competing client appetites. In the expense area, the allocation of expenses during a recent exam, and they have been horrible, the recent exams. The staff has a tone that is very different than during the Clayton administration. They're just got sharp teeth, and they're not very nice, and they come back with repeated additional requests. But in a recent one, I encountered a situation where it's a private equity manager. They had done a whole lot of research and paid for research on a particular investment. The fund made the investment. Later on, to a non-discretionary client, the advisor recommended the investment. There was some left over after their own flagship fund had been fully invested.
Yep.
And the staff came back and said, well, hang on a minute. The fund paid all the research for this recommendation, for this idea. how come you didn't allocate any of the research costs to the subsequent non-discretionary client? I don't know a temporal time period that they may not issue that question, but I think for private equity managers in particular, you got to be careful who else you're recommending an investment in something where your fund has paid for the research expenses. The staff has got a bee in their bonnet that even if after a period of time you make the same recommendation to another client, somehow you've got to go back and allocate the cost of the research to factor in that client, the subsequent client. I don't know how that's done. It doesn't comport with any kind of soft dollar allocation process. I haven't figured out, should the manager always absorb a piece of research? Is that the safer bet?
Yeah, and kind of related to that, I've seen more of a focus, although you see more of this than I do, where, unsurprisingly, where managers are warehousing deals either in a specific vehicle or oftentimes in some other fund, and then later selling it to another fund, a newer fund, whatever it is, and they're looking a lot more at how those valuations are being done.
Those valuations are very important, right?
Right, for the valuations, but also for the kind of the reasons that you're talking about, which is the at its most basic, is the original purchaser being fairly compensated for everything, including the risk and all the rest of the kind of stuff.
Right. And heaven forbid one of those accounts in that kind of a principal or cross trade should be subject to Erisa. Then your head explodes, right, Erin?
Yeah, absolutely. Layers on another exposure point.
All right, Tim, thank you. What would you like to talk about next?
Yeah, well, I was just going to let me just talk a little bit about, and then I can then I can still leave you maybe a few more minutes if that makes sense. Just kind of related to that, we talked a little bit about how kind of all this fits together, and it's important that folks realize that the disclosure, the expense disclosure and covenants in the ADV, the risk factors in the ADV, all the other disclosure that goes into the ADV matches the PPM, the risk factors, the conflict disclosure, the allocation section. In the LPAs, obviously the LPA shouldn't be a disclosure document. She should be more of a mechanical document, legal document. But if you're, for example, I have clients that have particular funds which have priority for certain investments over other funds. You got to make sure that that's kind of working properly between the PPMs and the LPA, and the mechanics actually work. And then just one little thing which kind of irks me perhaps I'm just becoming older, but I think that people have gotten quite sloppy in their side letter, how they deal with side letters. Oftentimes they are giving away in side letters. Essentially, they're allowing allocations to be negotiated in side letters. Sometimes there are expense issues also, but the real issue is allocations, and then aren't updating and especially because those can be quite material to the other investors, aren't updating the PPM disclosure or amending the documents and getting consent for those kinds of changes. The SEC has really been drilling down on side letters over the last few years, and I think that people are especially playing with fire when it comes to those kinds of issues. And that's true here in the U.S. and in Europe also.
Is it also playing with fire if you sometimes agree in a side letter that the management company will absorb the proportionate amount of expenses allocated to that particular investor, but you don't tell other investors that you might do that?
I think that generally falls under the kind of the no harm, no foul kind of rule. Generally, I think those kind of changes are okay. But it's really it's kind of the other stuff that would truly
And
impact the other investors.
as a follow-up, ERISA investors are very sensitive. They can only really want to pay for necessary, direct, and reasonable expenses. And so it's very typical for them to ask for, we're not paying any entertainment expenses, we're not paying any placement fees. They're definitely side letter negotiations that are very common on the expense allocation for ERISAs. No off, overhead, and sometimes and so I wanted, would that trigger any of these concerns, or would that just follow in this kind of no harm, no foul?
I think generally, the clients, at least when we have those kind of issues come up with the risk funds, they adhere to if we're not going to do it for this, the big bulky ERISA investor, we won't ding the other investors, the other clients for it. That's kind of the best, that's kind of the best way to deal with that kind of stuff. Also, I think, internally it just becomes a mess, right? Allocating this expense to this, it just becomes very difficult. And it's kind of fraught with, potential screw ups. So we don't recommend folks do that.
And speaking of full and fair disclosure, which we always have to speak about, and I'm not criticizing the way fund documents are drafted, but I've seen expenses that will be borne by the fund in a single paragraph that runs into 2 pages with Roman numeral. I have to look up what that is because beyond L, I get confused. Is that full and fair disclosure, Tim? I mean, and I always hear, well, Steph, we got to be market, not from my colleagues, but outside, this is the way everybody does it. Is that full and fair disclosure? Or are we just waiting for a case that when it gets up to Roman numeral L, which is 50, last I looked, that all those expenses are borne by the fund, that constitutes full and fair disclosure? Just need to know if we need to be prepared for that.
So I just, Stephanie, we're friends, so I can only laugh. I think, I don't know if there's anyone from KKR on the phone, but I think KKR, essentially what happened was, KKR happened, and then you could look at the PPMs and you get the black lines of the expense section of the LPAs, and they would essentially just double in size because people just went, pedal to the metal, they put everything into the expense section. And I agree with you. I think it does 2 things. One is, if you're representing the sponsor, of course, the investors look at the black line because, this would, you get a black line from fund 3 to fund 4. You have this new expense section, and you're kind of like, I didn't know all this stuff was in there before. And then you have, LPs negotiating every little last thing kind of thing, right? It also doesn't give a ton of flexibility oftentimes to the sponsor, because if it's not kind of all there, it becomes, I think, harder for those documents. I think oftentimes won't age very well. So, but yeah, I agree. Having expense sections which go on for multiple pages certainly isn't user friendly.
Well, it won't be it won't be received well by the regulator. Let's just put it that way. But, we do write them and we do see them, and they are state of the art. And one can only hope that the SEC will be reasonable on exams. Tim, should we turn to the next slide?
Yeah, well, I think we've gone through most of this stuff. The only other thing I think I wanted to cover, because I know we're very short on time, are one thing that we have seen is our co-investment vehicles. And I just wanted to touch on that just a little bit because we have seen just a huge number of co-investment vehicles and different kind of deals because the larger investors are just so desire to get co-investment allocations. So we do straight up co-investments, sort of one-off deals. We do funds for co-investments. We do platform deals for co-investments. Again, a lot of the same allocation issues, whether or not some of those co-investment vehicles are getting some priority and whether that's properly disclosed in the flagship funds documents. But also, oftentimes those co-investment vehicles have quite different expense mechanics in them. Classically, co-investment vehicles in the buyout, at least in the buyout space, don't have management fees and carry. But sometimes managers, especially in the last couple of years, where the pendulum has swung more towards the managers and their ability to kind of get away with things, they have allocated in those co-investment vehicles due diligence expenses, sometimes internal legal and accounting expenses, stuff that you kind of see classically would be picked up by the manager, are allocated to those co-investment vehicles. So again, you want to be careful about how the allocations are being done and that you're not jamming, for example, the co-investment vehicle, because you can allocate expenses to that vehicle, jamming a disproportionate number of those expenses to those vehicles. So.
Right. Thank you all. We'll just move to the next slide. And did we get through all of these, Tim?
Yeah, I think we're all the way through. Yep.
Okay, go back. There you go. Thank you, Erin, Christina, and Tim. I am part of the design of this program, so unfortunately for some of you anyway, I will be on the other panels, and so I will cover some of these points on those other panels, which is an inducement, or maybe not, for coming back for more. If we could go to the next slide, please. There we go. So I'm just going to pick on a couple of things since I only have a few minutes, and I've left for the end something that I think is cute. And those of you who have been to this program before don't always agree with my sense of cute, but I'm going to leave you with something I think is cute. In the meantime, before we get there, I just want to reiterate what Christina said. There are 49 items on the Reg Flex agenda. That's unheard of at the SEC. You might hear more on the enforcement panel about proposals to change Rule 10b5-1 plans, dealing with insiders and giving insiders the opportunity to sell their own stock in a company. We might get to that on the enforcement panel. They're going to do something with SPACs, but they didn't specify. Thank God, maybe. Be careful what you wish for. Amendments to the custody rule. Tim, the only thing I would clarify in terms of rolling out the importance of topics during exams, yes, unquestionably insider trading is a big one. And yes, unquestionably allocations are. But the number one issue, the number one deficiency, and the number one vexing problem for people in this industry is this daggone custody rule. It's the worst rule that was ever written. We don't invite regulators onto this program, but if one happens to be on and heard me just say that, well, it's true. It's the worst. It's horrible. And it is not the number one deficiency because every investment manager is stealing clients' money. It's the number one deficiency because the rule is impossible to follow. Form PF, your guess is as good as mine. How that changes, I hope the burden is eased. Rule 17A7, that involves Cross trades mostly, it's described as principal trades involving a registered investment company portfolio and another portfolio managed by the same advisor. We'll have to see what that is. Money market fund reforms, I don't even know what that's going to involve. Next slide, please, so we can get through this in a minute. So the exams, I said in the beginning, the tone has changed, and it sure has. And maybe those are growing pains because the Office of Compliance Inspections and Examinations grew some into a full-fledged division. So now they think who the hell they are. But the tone is lousy. I can't sugarcoat that. I think everybody needs to be prepared for a very tough exam. We're close to finishing the 5th of 5 in the last month and a half. OC, or the Division of Examinations, issued 10 risk alerts. That, again, is extraordinary. They are bragging to the effect that they issued 2,000 deficiency letters. I don't know about bragging, but that's what it is. They are actually verifying the existence of assets with custodians. They call accountants when you are relying on the audit exemption under the custody rule. They call the accountants and ask them about their reviews. And they do call the custodians to verify assets. Again, the number one top priority is custody and the custody rule. It is very painful to go through that in an exam. Fee miscalculations, it's a perennial favorite. I don't think I have to describe it anymore other than to say, depending upon what kind of clients you have, fee miscalculations, or said more positively, the way you are calculating fees deserves to be reviewed and tested. In as much as you may think that everything is mechanical and systematized, in fact, it really isn't. And they don't like mistakes in your favor, and they don't like mistakes against you. So they have brought actions and will continue to bring actions, whether the miscalculation works to your favor or against you. Next slide, please. 130 enforcement referrals last year. These are the subject matters, and you'll all get this in your materials. These are the kinds of cases they're bringing, but there are others, believe me. They have this new team called the ERT team. As best as I can tell, this is the team with vision. They can see around the corner to the next big risk that everybody should also be seeing around the corner. I don't know, Christina, if you like this team. You know, as a taxpayer, I would have liked to have interviewed the people on this team to see if their vision might be the same as my vision. But who's to say what the emerging risk examination team is going to be about? They are raising the importance of supervision all over the place. You'll hear more on the enforcement panel. This, I think, is driven in large part by the continuation of remote work. Priorities, Christina, as you said before, and Erin, it's fundamental to what you said. Retail investors, teachers, seniors, military people, and retirement savers. Now, Tim, I would say one thing to you. You know, we don't worry so much when Erisa plans, and this is for you too, Erin, when Erisa plans become investors in funds, provided they don't convert those funds into plan assets. So we stay below the 25%. But you might recall during prior administrations and commissions that they started to care an awful lot when certain people in enforcement said, well, wait a minute, you know, okay, Erisa doesn't apply to you. But, you know, the teachers' retirement system of Poughkeepsie is an investor in your fund. And now all of a sudden we are going to care, and we're going to care a lot more about what those funds are doing. So it's not a look through, but it's awfully close.
right? Those types of plans do like to negotiate ERISA like fiduciary standards of care with the asset managers. We try to really avoid using ERISA fiduciary standard of care when ERISA doesn't apply to these public plans. And we have other ways of drafting responses to that. So will be a fiduciary under the Advisors Act, under Delaware law, to the fund, but that is something that often does come up when you have governmental plan and public plan investors.
Well, and the other point to make about that is that we like to think about ERISA plans as institutional investors and equate the standard of care and the treatment as we would a direct institutional investor. And in the past, there have been previous commissions who've said, it's not really an institutional investor when it is a retirement plan that is managing teachers and firefighters and other public employees, and challenge the applicability of an institutional approach to hedge clauses and reductions of risks and indemnifications. So I hope I'm wrong. I hope the commission doesn't go in this direction. We will have to see. Next
That would
slide.
be terrible.
Right. Again, these are some of the priorities that the staff has identified in their examination priorities. We have materials we've attached to this presentation, including alerts that describe the priorities. And I encourage you to read that. Next slide, please. Just one point, and then I think we're done with this presentation. In July, the commission issued their observations, the OC, or I guess it was a division by then, their observations regarding fixed income principal and cross trades. There's really nothing new here, and there's nothing in this observation that doesn't equally apply to all other kinds of assets. You have to have a compliance program. You have to have conflicts of interest disclosure. You have to deal with, in the principal transaction area, written disclosure of the terms and consent prior to each principal transaction. Of note, for anyone who pays close attention to this, in a cross trade, they said in this release that it would not be considered a principal transaction if an advisor crossed a security from one account to another, and I'm reading into it including a registered fund, provided that there was a one-day turnaround of going back and buying it. So I'm doing short shrift of this, and I encourage anybody who is interested, particularly where you have registered fund clients. There are circumstances and cases where the staff has said it's a principal transaction if you take out of a registered fund portfolio a security, you place it into the market for trade, and then within 24 hours, you buy that security into another account, that is a 17A violation. I'm reading this as saying, if you subject it to the market for between 1 and 3 days, that is not deemed to be a principal transaction. And it's the first time that I've ever seen that put in writing. So if anyone's interested, you might want to take a look at this observation. I hope you enjoyed today's presentation, and I hope to see many of you next time. Thanks.